trade that I basically had on Bitcoin from probably a couple of months ago, sometime in June, was I basically had the 10,000 calls in end of July expiry. So can you see 31st of July? This is the chain of options, okay? So I had the 10,000 calls, which cost roughly $250, okay? And against that, I sold some September 14,000 calls. So 40% above in terms of from 10,000, 40% out of the money. And I sold them in like a ratio. So let's say I bought 2 contracts of the July 10,000s for about $250, and then I sold like 3 contracts of the Septembers. Okay, and the idea being that I wanted to minimize my overall cost, yeah, and that structure. But I wanted to have some exposure to a rally through 10,000 because I thought there was half a decent chance that it could break 10,000. If it went between 10 and 12 or 10 and 13,000, my Julys would go massively intrinsic. They'd go in the money and they'd be worth over 1,000, 2,000. And my Septembers, I thought the implied vol on them was high enough that even if we got up there, they might just sort of double in value or something like that, right? Double, or they wouldn't do me too much damage. That was the idea, okay? And I was also taking advantage of the term structure, which is basically the difference in volatility between different expiry options, right? So you had an insanely steep term structure where you could buy those July options on an implied vol of say 50, right? And you could sell the September options on those higher strikes of an implied vol of about 75, something like that, okay? So in general, the structure was relatively zero cost, or didn't cost me to have much initial outlay, and that was the idea, okay? Now, as it happened, the market kind of did nothing and drifted down towards, I probably did the trade when the market was around 9,500, and it kind of just stayed at the bottom end of that range for a long time. So when we were down towards 9,000, my July options were pretty much worthless. They were worth like $50. So they've gone from $250 to $50. But the September options had got crushed as well, right? So the September options had gone from, let's say, $300 to $100. So they decayed, and they'd been doing their job of going down in value whilst my July had gone down in value. So at that point, I was looking at the market, and I was looking at gold breaking out and silver breaking out, and I was scratching my head as to why crypto hadn't done anything yet. And it just felt like it didn't make sense to be short that many of those Septembers anymore for $100 when I'd made 2/3 of the premium. But by being short something from 300, it's gone down to 100, and it still doesn't expire until the end of September. It didn't feel like it made that much sense to stay short them. Well, certainly not all of them, right? So I covered more than half of those options in September at about $100. So that was good. So I cashed in on that. But the Julys, I still thought the Julys were going to die worthless, right? I didn't know that we were going to get this spike happen literally in the last week, right? So now, I had a bit of luck that now all of a sudden the Julys have gone from being worth $50 to what they are now. They're 1,000 points intrinsic, right? So they are worth, they're worth $11.50 or something now, right? So then I'm looking at these options that have gone that are worth 1,000, and I'm thinking now their delta. They went from 0 delta to 96 delta options. Okay. So they are now making me very, very long Bitcoin, right? So if Bitcoin decides to drop $500, they're 100 delta options, right? So I'm going to lose $500 per option on that, okay? So it's kind of, and literally they expire on Friday, or they expire on Friday. So it's kind of, am I that sure that by Friday that we're not going to drop, right? And do I want, effectively, I've got Delta 1 exposure now between this level and going back to 10,000. And that felt a bit I wasn't in it for that, right? I wasn't in it to have that delta one exposure, right? So I kind of needed to think, how do I restructure this trade? Yeah. So what do you think? What do you think I did? So what would you do? Well, what are the potential options that I had?
Sell them, take your money and run.
That's one option. But now that Bitcoin's broken 10,500, what's to stop it going to 14,000 in short order? And if it goes there, am I going to be happy that I took the money and ran after making $1,000 on those options? Probably not, right? Because we've been waiting. Like, if you look at the chart on Bitcoin, like, you've seen it, yeah? Chop coiling, and now we've broken to the upside, right? There's definitely potential for this move to extend, right? Especially when you look at what gold and everything's doing. So having zero upside exposure isn't what I want to do, right? So the question is, if I'm going to take those options off, that makes sense because they've got 2 days left to expiry and they've just become like a digital now, right? They're either going to double in value because we rally another 1,000, or they're going to go at zero if we go down 1,000 points, and I don't want to really be exposed to that. So they're not giving me the optionality that I want, right? So it makes sense to bank the money and get rid of those, obviously. But then the question is, what do I replace them with?
I mean, if you want to keep the same view, you can just roll them forward.
So roll them forward. Problem with rolling them forward is, what do you think's happened to the implied vol? We've just exploded 20% higher in a matter of days, right? Whereas the implied vol was kind of in the 40s on the front end of the curve. Now the implied vol, let's say if we look at a 1 month option, the implied vol is for the at the money stuff is like 60, 65 now. So it's jumped by nearly 20 vols, right? Which is significant, yeah. And so whereas I was buying options initially, let's say we were at 9,000-ish, and I was buying the 10,000 call with about a month or more to expiry, and I was buying that for $250. The same call, right? The 1,000 point out of the money call now is looking like it's worth about $500, $550. So it's like double the price of what the old option that I first bought was worth, right? So feels a bit expensive, right? I think. So I didn't do that. What else could I have done? So I didn't roll it a month into the future. Okay. What else could I do? What other options have I got?
I mean, you saying that you didn't specifically roll it a month into the future, I feel like that you're implying that you might have done something similar, but like with a further time to maturity. So you maybe
the problem with the further time to maturity, well, first of all, I'm short the calls in September, right? But I'll let you. But I did cover some more of those. But the calls that I'm short in September are now worth $470. Okay, the 14,000 strikes. And they're on a 68, 69 vol. So their volatility has actually been quite stable. Like they were on that vol before. We've exploded 20% higher and they're kind of on the same vol, right? So that's worked really well because I've been short Vega on that option and the vol hasn't moved. And I've been long Vega on the short dated options and they've just gone nuts, right? So that's worked well. The problem is now to own the short dated options, I'm paying up an expensive vol, right? If I'm buying those, yeah? So what I've ended up doing is I actually have I've partially rolled. So I basically said I can bang out. I had 2 contracts of those Julys that were worth over 1,000. So I sold those both out. That took in $2,000 of premium. Okay. And I've said, you know what? Given the way Bitcoin often behaves, when it decides to break, it can do it quite quickly, basically, right? So although I'm not willing to wait 2 days, I'm not willing to take the risk that it's just going to keep going for the next 2 days. I think rolling to next Friday buys me some time and gives me some upside exposure to this thing just going a bit nuts and going to like 13, 14,000 quickly, which we know it can do, right? If you looked at past breakouts in Bitcoin and how quickly it can snowball, right, I wouldn't be overly surprised to see it in the 12.5 to 13,000 area by the end of next week. Okay. So what I've done is I said, all right, I'm willing to stake some of the money that I've made in those July options. I'm willing to stake some of it on some leverage in next week, right? So on the 7th of August, I bought one contract of the 11,500 for like $300, and I bought one contract of the 12,500 for like $100. Okay, so I've stuck $400 of the money that I've taken off the table. I've taken $2,000 off the table, and I've put a fifth of that into some leverage upside for next week, right? In case this explosion continues. Okay, so that's my punt, right? That's my bet that if this thing keeps snowballing, I want to make some cash off it. Okay, I want to have some exposure to it. But that's my short-term play, right? That's going to die next week. So if we end up just sitting here or going nowhere or going lower, that 400 is going to go pop, and I don't want to necessarily keep spending that, right? So that's one thing I've done. But what else could I do to get long delta exposure, knowing now that the volatility of Bitcoin has gone up a bit? What else could I do to get long?
Sell some puts.
Sell some puts. But selling puts outright is quite risky and quite dangerous, right? So I've sold put spreads instead, right? So I've sold some August put spreads, some 10,000, 8,000 put spreads, which are worth about $200. I've sold those, and I've sold some Septembers. I was already short some Septembers, but I've kind of rolled up the short strike, right? So I'm short like the 9,500, and I'm long the 6,000s behind it. So it's a wider put spread, but earning about $350 for that basically. Right? So that's the way I've done it, because we've had this explosion higher, and because I now think that break of 10,000 should act as a bit of support, that 10.5 area. I'm basically selling puts that are struck just below that level. But I'm selling put spreads just to contain my risk, right? Because I don't want some ridiculous, unforeseen liquidation event to happen and I get stopped out. So I can control my risk by selling put spreads rather than puts. But they are a way of me getting back some delta exposure. And that I've done that for end of August expiry. I've done one of them for end of August. I've done one of them for September. So I've spread my risk around a little bit there. And like I said, I've got those super short dated upsides in 7th of August expiring next Friday, should this thing really explode to the upside, and that'll give me some participation, right? And so I took my delta, my overall delta was about 1.2 contracts worth of Bitcoin. I've taken it down to about 0.7, right? So I've taken some delta off the table, I've taken some premium off the table, but I know now that if we get the explosion, my delta will go up again because I'll start blasting through my short-dated calls again and they'll pick up delta. But if we go down, I've locked in that good money on those July options that I've taken off the table, and then those put spreads that I'm short, they are sort of more medium-term positions that I'm comfortable with, basically, right? That I think will earn me premium over time, and I'll capture that premium over time. And if we do see that, if we see Bitcoin kind of drift or come back down to like that 10.5 level, but it does it slowly over the next month, they're probably going to hit implied vols back down again, right? And I might get the opportunity to do a similar trade to what I did, where I can buy those 1 month options again at a cheap level, and then fund them with the more expensive stuff that seems to stay on that higher implied vol as the term structure steepens again, basically, right? But right now, you've had a term structure where short end has popped, and you're actually looking at a much more flat term structure. So the relative value just isn't there to be doing that trade for me, right?